Throughout time, gold has endured as an asset and continues to be in demand, trusted by individuals, institutions, and nations. Whether to preserve wealth, diversify portfolios, or strengthen national reserves, gold remains a symbol of stability and value. For a trusted asset vaulted in Singapore, investors can look to the Lion Global Singapore Physical Gold Fund. Unlike many gold funds, Singapore's first physical gold fund is backed by physical gold, fully insured and securely vaulted in Singapore. An asset you trust seeks a home you can trust. Lion Global Singapore Physical Gold Fund, valued worldwide, vaulted in Singapore. Visit our website for details.
All right, ladies and gentlemen, thank you so much for that. I look across the room and I'm really encouraged. I can feel the animal spirits coming in 2026. And I want to give a quick shout out to my team at the back. We are right there talking about gold. We've been here since 8:30 in the morning and we're still going strong. I'd like to thank Joshua and the team at Fund Supermart for having us once again this year. Partnership with Lion Global and Fund Supermart running strong. And I'd like to thank each and every one of you here today. The room is filled. There's standing room at the back. I see people crowding at the side. This feeling is amazing. So thank you for joining us at the very last presentation of today. And we've seen a lot of speakers here today, all very attractive, intelligent speakers saying very interesting things. I'm not sure I'm as attractive or as intelligent as any of them. So I'd like to talk about something slightly different. I want to talk about gold. And gold has been with us for more than 5,000 years. And in that time, gold has never defaulted. Gold has never gone bankrupt. And the value of gold has never gone to zero. And that is why it is a trusted asset that is valued worldwide. So what I want to do in the time that I've been given is to talk about how we got here today, how gold got here today, what it can do for your portfolios, and how you can invest in gold and keep it safe so you don't have to worry about losing it. My name is Nick from Lion Global Investors. Lion Global is the asset management arm of OCBC Group, managing in excess of $78 billion worth of assets across equities, bonds, and multi-assets. And in December 2025, we launched Singapore's first physical gold fund with every gold bar stored here in Singapore. Singapore is our trusted home. We know that it's trusted. There is strong rule of law. There is low crime and low corruption. And we know that a large percentage of the male population in Singapore has taken the SAF pledge to preserve and protect the honor and independence of Singapore with our lives. That's how they train us to say it. The training runs deep, yeah? So we know that Singapore is a trusted jurisdiction. The rest of the world, however, trusts Singapore because since independence in 1965, Singapore has never taken control of other people's gold. There are a couple of grey boxes here, right? Prior to 1971, when the gold standard was in play, when gold was money, the nations of the day, from US to UK, occasionally would take control of people's gold. What does that mean? That means that they would transfer ownership, usually from private ownership to state ownership. They would restrict ownership. They restrict the amount of gold that you can hold. Or they would suspend trading altogether. And that's what happened in 1971, when the US decided to abandon the gold standard, and gold was then allowed to trade freely. And trade freely it has, because since then, everybody has been buying gold, and gold prices have continued to climb up, up, up. It's easy to focus on the gains and forget about the risk. It's easy to focus on the 150% rally that we've seen and forget that preceding that, there was a 40% correction, a 50% rebound, and a 20% retracement. It's easy to get lost in the sentiment and forget about the fundamentals of gold. So let's look a little bit into the fundamentals of gold. Unlike equities that have earnings, unlike bonds that have coupons, a lot of people will say, and they are correct, that gold does not generate income. Right? Gold has been around for more than 5,000 years. Gold is a very old asset. You don't expect a grandmother to give birth. You don't expect a gold to generate income because that is not what it was designed to do. There are other things that gold won't do. Gold will not react to oxygen. Gold will not react to moisture. Gold will not melt in most acids. You can beat gold. You can reshape gold. You can melt gold down. It is still gold. You can take a gold coin, put it in your mouth and bite down. It becomes a Bitcoin, but it is still gold. So these are the reasons why gold has fundamental value. Whatever happens around it, whatever happens to it, it's still gold. And that is why it is still a trusted asset. And we look at gold not because we think it's going to go to $10,000, but we think that demand for gold is still going to outpace supply. So let's look at the demand and supply factors here. Number one, unlike most industries, the supply of gold has become less efficient, not more efficient. Right? In the past, you could stick a shovel in the ground and you were mining gold, and hopefully gold will come out. Today, because of all the permitting and all the developments and all the environmental protection that we need to undertake before mining gold, it takes between 10 to 20 years before you can even start producing a single gram of gold from the ground that hopefully you dig. Secondly, once upon a time in the 1900s, you could dig out a ton of rock and it would yield you around 20 grams of gold. Today, you can dig up the same ton of rock, and it will only give you 1.5 grams of gold. Supply is getting constrained, and is only growing more constrained. On the other hand, demand has continued to grow. If you look at the pie charts in the slide, you will see that the demand for gold comes from four main sources: jewelry and technology, and this is relatively stable. What has really grown in recent years is demand for gold from government institutions and from investors. So the question really is, will demand continue to outpace supply? And we can look into that by starting with government institutions. You can see from the chart on the left side that the gray line shows government institutions have been adding approximately 1,000 tons of gold since 2020. That's about 5 years ago. We know that this is a global trend because if you look at who has been adding gold, it's all over the emerging world outside of US and Europe. You can see it in North Asia, you see it in South Asia, you see it in Southeast Asia, Middle East, and Eastern Europe. This is called a worldwide phenomenon. And why are global institutions increasing their allocation to gold? Well, they're worried about things like sovereign risk. They're worried about the US dollar, $38 trillion worth of debt and counting. They're worried about the dollar no longer being a safe, a global reserve currency as it was. And the data here shows that this trend is truly well in place. You start in year 2000, the US dollar as a percentage of global reserves was approximately 70%. Fast forward to 2024, based on the latest data that we have, it has now fallen below 59%. And while that is happening, gold has continued to grow and grow and grow as a percentage of overall reserves. So is the demand for gold from government institutions likely to be stable? Well, with this trend in place, we think that it is more likely to be stable. And they are not the only ones buying gold because investors are always also buying gold. Historically, the demand for gold as investment has been anchored by US and Europe. But in recent years, if you look at the chart on the left, you'll see that there are a couple of yellow bars that start to appear towards the last couple of years. And that is demand coming from Asian investments. Now, Asian investments have grown, pie chart on the right, from 77 tons about 5 years ago. And today is about 400 tons. But taken relative to Europe and US, 400 tons is still very, very far behind from the developed world. And we think as China emerges and as the rest of Asia starts to understand the benefits of gold, this will likely continue, and hence demand for investments out of Asia for gold is likely to be a stable source of demand. And let's talk about the benefits of gold, like I mentioned. The position here at LGI is that you shouldn't buy gold because you think it's going to double in price. You should be buying gold because equities could be cut in half. Gold may not be the investment that a lot of people say it is. We see it as portfolio insurance. Insurance to protect your portfolio from unexpected shocks. And when you buy insurance, you don't buy so much insurance that it becomes a burden. You buy just enough. How much is just enough? Well, the data here shows that if you're looking at a global portfolio of global equities and US bonds, just allocating 10% is enough to improve your return and reduce your risk. A lot of people will say, oh, a lot of US, very, very good. What about Singapore? Okay, we ran the same numbers in Singapore, just to show you. And the same pattern appears. If you're buying a portfolio of Singapore equities and Singapore bonds, having a 10% allocation of gold increases your return, reduces your risk, once again, across multiple time frames. So with this pattern in place, we think that it makes a lot of sense for investors to consider having some allocation to gold. Now. Why do I say now? Because we are in an interesting time. I think a lot of people will note that markets are expensive, right? So we crunched the numbers. We took all of the valuations we could find, the price-to-book ratio of the MSCI World Global Equities, and we plotted them in the gray line on the chart here. And we arranged them from low, all the way in the left, to high, all the way to the right. And then we calculated the 12-month forward returns, the subsequent 12-month returns of gold from that valuation point. And the pattern that emerges is very interesting because if you buy gold when valuations of equities are high, your returns from gold tend to be more consistently positive. Whereas if you buy gold when the valuations are low, the results are a little bit more mixed. This chart cuts off at 3.5 times price to book. Today, the price to book ratio of global equities is close to 4 times. If that is not high valuations, then I don't know what is high valuations. And therefore, now is a very interesting time for investors to consider an allocation to gold. When valuations are high, sometimes markets like to correct, right? What happens to gold when markets correct? We looked at 25 years of data across which you could see 10 incidences of crises across equity markets. You have the dot-com crisis, you have a sovereign debt crisis, you got a COVID crisis, you have the Trump tariff, taper tantrum, the China property crisis, and all sorts of crises over the past 25 years. And in each one of these 10 crises, gold has done better. When equities crack, gold shines. And in 9 of the 10 times, gold had a positive return, when equities had a negative return. And in one of those 10 times, in 2022, gold had a negative return, but it still did better than equities. For this reason, gold is known as a safe haven, because when equities drop, gold tends to hold up or at least appreciate in value. Gold is also known as a long-term preserver of wealth, and this is why. This chart here, the gray line should be very familiar. This shows the amount of US dollar it takes to buy 1 ounce of gold, right? And that has gone up, up, up. You invert that. You take the denominator and put it to the numerator, take the numerator and slap it on the denominator, and you will see the amount of gold it takes to buy 1 US dollar. And that amount of gold has been dropping. It takes less gold now than it did in 2009 to buy the same US dollar. That means that the value of the US dollar purchasing power has been declining over time. And this presents an interesting question to people who are looking to pass on generational wealth from one generation to the next. Because when you're talking in generations, you're not talking about 1 year or 3 years, right? You're talking in terms of 20 years or more. But what kind of wealth do you want to hand down? And this is the question that's being asked for investors who are looking to pass on wealth in US dollar. Same question that's being asked by investors who are looking to pass down wealth in euros, in renminbi, in Japanese yen, or in Sing dollars. The pattern is the same. The value of the fiat currency has been depreciating relative to gold. So the question is, if you're looking to pass on generational wealth, are you looking to pass it on in an asset that will likely depreciate over time? Or are you looking to pass it on in an asset that will likely preserve value over time? And these are the 3 reasons summarized for your convenience why gold makes sense today. Number 1, it is going to diversify your portfolio, less risk, more return. It is a safe haven, equities crack, gold will shine, and it gives you that value preservation versus fiat currencies. And if you believe in that and want to consider an allocation to gold, your trusted asset needs a trusted home. So let's look at the ways that people can invest in gold. One of the most popular ways for people to invest in gold is to go down to a bank. I will not name the bank, but you know which bank. Buy a gold bar there, and you put it in a pocket, and if it drops and hits the floor and becomes damaged, then you have discovered the value of insurance. Other thing you can do is to buy a gold ETF. And we know there are good gold ETFs out there. All their gold is stored somewhere either in the US or in the UK. And if you are worried about sovereign risk, then you may or may not feel comfortable with the fact that your gold is an entire time zone away. The third way you can get access to gold is to buy gold miners. And there's nothing wrong with that. We have a lot of wonderful gold mining funds, and gold miners do offer historically higher volatility to gold prices. Why? Because you are taking more risks. When you buy a physical gold fund, you're buying the exposure to the gold price. You buy a gold miner, you're getting exposure to the gold price, you're getting exposure to the risk that the gold miner can efficiently extract gold from the ground and then efficiently sell it to the market and do no sort of balance sheet shenanigans that sometimes corporates do. So there are different set of risks. I'm not saying one is better than the other. I'm saying the risk you're taking in gold miners is different. So we thought we can come up with something closer to a more ideal solution, and that is why we launched the Lion Global Singapore Physical Gold Fund. We buy nothing but gold bars. Every dollar that we buy will be used to purchase LBMA standard gold bars. Every single bar that the fund holds will be held here in Singapore. And we work with our custodian, Standard Chartered Bank, to make sure that every bar of gold is stored securely in a vault at the Freeport. And we can talk about the security measures there. And because we are very kiasu, we believe that even though all the security measures in place, we still take the added step to ensure every single gold bar that is held by the fund. And of course, because it's a unit trust, you can trade in and out of it. You can right-size your investment every dealing day. We know we are not the only gold fund out there. Look, we don't live in a bubble. You know that there are other gold funds that offer exposure to physical gold. The difference between us and them is that we are the only gold fund that has all of its gold bars vaulted here in Singapore. And we are the only gold fund that has full insurance on the full value of the gold bars. I tell you this, but don't take my word for it. Please, the responsible thing for me to do is to direct you to the prospectus. Go to our website, check out the prospectus, Section 8, Clause 8, read the portion about full insurance of the gold bars. And that is what differentiates us from the other gold funds that are available in the market. These are the kind of bars we buy. These are called LBMA. LBMA stands for London Bullion Markets Association. And they set the bar, I'm sorry to say that, they set the bar for gold bars. If you are buying LBMA bars, your bars are able to be traded internationally. And they meet very strict criteria for purity. They meet strict criteria for weight. You have to have certain markings and the dimensions, they're all fixed. And we want to take good care of these gold bars because if they get damaged, then the value of the gold bar goes down. Hence the importance of insurance. And Singapore also sets a very high bar for where you want to store your gold. Because if you look at other developed Asian jurisdictions, not called China, Singapore is one of the few that checks all boxes. Low risk of natural disasters. I'm sorry, bonding is not a natural disaster. Strong domestic rule of law, stable politics, and outside of Singapore, we have relatively stable foreign relations with our neighbors. If you think about all the different jurisdictions, not many will check all of the three boxes. But even though Singapore is a stable jurisdiction, we also want a very secure location for all our gold to be stored. And here it is. You can look this up in Google Maps. It is public information. The Freeport has been appointed by the custodian of the fund, Standard Chartered Bank, to hold every single gold bar. The features they have proximity to Changi Airport, so in case we need to buy gold from overseas, it moves the shortest distance possible directly into the vault. It has security features like 24/7 security, armed guards, it has CCTV cameras, it has electronic monitoring of all visitors, it has a nitrogen gas fire retarding system that will flood the entire vault full of nitrogen if in the event that a fire breaks out. And heaven help you if you happen to be inside the vault when the nitrogen floods. Because last time I checked, my lungs cannot breathe nitrogen, and that means that the employees there, if they happen to get caught, right? That's how seriously they take their security there. And that's why we know that the gold will be securely vaulted. And we still have insurance, which we've talked about. Now, you could do this yourself. You can try buying the gold from a bank or your trusted gold dealer. You can try getting your own vault. You can try to purchase your own insurance policy. And I promise you, we looked at the numbers, we try and source for a couple of quotes, and it will be more expensive if you do that. Because number one, when you're buying gold bars, you are paying spreads, right? The bigger the gold bar, the smaller the spread. But if you're buying in small amounts, in this illustration, we looked at $100,000, which is a pretty reasonable amount for average investors like you and me, if I wanted to build a position in gold. Because anything smaller is going to be a massive spread. You can calculate this yourself. You can go to any website that publishes the buy and sell prices, take the difference, divide it by the spot gold price, that tells you the spread. Okay, this is mathematics. I'm not saying anything controversial here. You can calculate for yourself. A 1 gram gold bar, the spread can be as high as more than 20%. 20%! You take a $1, you lose $2 straight away, right? 20 cents straight away. Whereas if you buy it through a gold fund, you're looking at a management fee of 0.4% per annum. What does that mean? That means if you put in $100, the management fee that we charge in 1 year, 40 cents. So we think it is more efficient, especially if you're looking at smaller investments. So with us, you pay less. Without us, you pay more. The mathematics, your choice. So this is the reason why we think a gold fund approach to investing in gold makes sense. Number one, A is accessible. C is convenient. You don't have to worry about logistics. And E, maybe most importantly, is efficient. You pay less with us, you pay more without us. So for that reason, if you are thinking about an allocation to gold, or you're thinking of adding gold to your portfolio, your trusted asset needs a trusted home. So consider Singapore. Consider Lion Global Singapore Physical Gold Fund. And my name is Nick from Lion Global Investors. I wish you peace and prosperity in 2026 and the years ahead. Thank you.